2 days ago, on the 5th of January, Goldman Sachs released a major update on Robinhood. They maintained their buy rating and set a 12-month price target of $161. That's actually a pretty big 35% upside from where we're trading today. Now, if you're looking at the headlines, the narrative is simple. Robinhood is the future of finance and it's screaming buy. But as someone who builds portfolios with a strict 5 to 10 name limit, I have to be more selective. By the end of this video, you'll understand why I love the CEO, I love the app, and I love the diversification, but I'm sitting on my hands at $120. Right, let's dive in. On the 3rd of January, just a few days ago, the US captured Maduro in a surprise operation while the rest of the world was waiting for the news to break on TV. A small group of anonymous traders on prediction markets were already cashing out. One specific account placed a $30,000 bet that Maduro would be out of power by the end of January. They locked in that bet just hours before the mission was confirmed. When the dust settled, that account walked with $436,000 in profit. That didn't seem like it was a lucky guess. The same account had been placing specific bets on the US invasion. From what I see, that's essentially legalized insider trading for the masses. As an investor, when I see that much fast money flowing through a loophole, I also see a giant target for regulators. And Congressman Richie Torres introduced the Public Integrity Act of 2026 to ban federal officials from trading these markets. Now, most people think regulation is a death blow, but I disagree. I think this is necessarily cleaning the house that prediction markets need to go mainstream. Think about it. The New York Stock Exchange, via its parent company, ICE, just poured $2 billion into poly markets. Coinbase and DraftKings are launching their own regulated versions. Major institutions aren't investing billions because they want to facilitate dark trades. They're doing it because prediction markets are becoming financial infrastructure. And actually, we've seen that they are more accurate than polls. They are more real-time than the news, and they provide a way forward for crowds to price reality. And Robinhood knows this. They're investing heavily to be the regulated gateway for this growth. But while I love the strategy and diversification, we still have to look at the price tag. Because even a world-changing product can be a bad investment if you pay too much for it. Now, why are the big banks still telling you to buy this? If you look at the Goldman note from just a couple days ago, their thesis rests on unparalleled product velocity. They aren't valuing Robinhood as a brokerage. They're valuing it as a tier 1 software company. They're banking on the Cortex AI upgrade and AI advisory they believe will hike revenue per user by 11% this year by turning passive investors into active traders. And I'll be honest, I actually agree with this story. I like the stock because of the macro environment for 2026 looks incredibly supportive. We have the One Big Beautiful Bill Act pumping nearly $100 billion in stimulus and tax refunds this season. Plus, we're seeing a Trump administration that seems focused on economic growth and a calmer geopolitical tone, which is perfect fuel for these prediction markets to continue taking off. And there's a reason why New York Exchange, parent company, Coinbase, and DraftKings are all piling into this space. They know that the digital house is the future. And as an app, Robinhood is fantastic. The CEO is doing a world-class job with diversification. But here's where the math starts to make me nervous. While I think Goldman's 161 target is likely correct for where we'll be in 12 months, the current multiple looks strange on a historical basis. We are trading at a price to sales ratio of 25.5x compared to a historical average closer to 11x. You are paying double the normal price for a company growing at 16%. Separately, even Tom Lee from Fundstrat, who is one of the biggest bulls on Wall Street, is calling for a 2-speed year in 2026. He expects the first half of the year to be volatile, a strategic reset across risk assets before a massive rally into the second half of the year. If we get that market-wide dip, do I think there's a high probability of Hood hitting $100 in the next few months? Yes. That would be a healthy 20% correction to clear out the froth and to bring those multiples back to reality. I run a very concentrated portfolio of only 5 to 10 names. Every ticker has to earn its keep on valuation. Right now, Hood is being priced like the next 3 years of growth are a sure thing. So I'm not buying at this level. I'm sitting on my hands and watching the $115 level very closely as our first line of support. The buy zone for me is around a $90 to $100 range. I think that's where it will go if we see a pullback in the coming months. At $100, those sale multiples start to look sane again. If you want to see the other names that actually made the cut for my portfolio this quarter, the ones I'm actually buying right now, let me know in the comments and I'll do a deep dive on those next. But for today, the move is patience. For those of you looking at this stock, Are you holding at $120? Are you waiting for a re-entry at a lower price? Let me know, and I'll see you in the next one.